Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto asset.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero, and we have a great episode for you today. Max Bareiss, head of lending at Galaxy, is our guest. First time ever for Max on the show. First time we've really dug into the lending market on this show at length. We're going to talk with Max about what Galaxy does in the lending world, what the trends are in crypto lending. We just published a huge report about this. The state of crypto lending has tons of data, never before seen data on centralized CeFi crypto lenders like Galaxy. So check that out. And of course, we'll check with our good friend Beimnet Abebe from Galaxy Trading. As always, talk about markets, macro, tariffs, and tantrums. And before we get to that, I need to remind you, please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. I am back in New York, back from Bedford, England, where the Bedford Pirates men's and women's teams both won their leagues and are promoted. Shout out to Peter McCormack and Emma and the whole team there in Bedford. It was an awesome weekend. Galaxy very proud to be the title sponsor for the Real Bedford Football Club women's team, which just capped an undefeated season to win the league and be promoted. Super fun. I can't believe the thing Pete has built out there. A few years ago, we talked to him. I thought he was insane, and he was insane. And I don't know. Finn, remember we talked to him? He's telling us about the struggles with the mayor and stuff, and that stuff's resolved. Universal Studios is building a theme park in Bedford. Absolutely crazy. Can't believe this is happening. And Pete's thing, Real Bedford, is actually working, and it's growing, and it's a great community and doing great things for his community. Couldn't be more proud to be a tiny part of it, and so happy for Pete and his family and everybody involved. Great time. Shout out Real Bedford Pirates. Let's get right into the show. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thank you for having me.
Man, just continues to plow along here in this new era. Bitcoin, I mean, got some decent allegory here, you know, just stuck here. You know, so what was the low, like 75?
Yeah, a little 74 and change.
75 to 88. It's like the new chop solidation from last year at the moment. No clear direction as where it wants to go. Maybe it wants to go lower, but same thing with kind of markets now. We're through the 90-day pause, but it's, I don't know. Well, what's happened since the 90-day tariff pause last week? Like, where do we find ourselves?
I mean, we had a decent recovery in stocks, the third biggest up day in the S&P's history. And since then, we have rolled back over. Today, most notably, some of the semiconductor export constraints kind of hit the tape today, and so, you know, Nvidia's down like 10% on the day, and that's a really popular retail name and also a large component of the NASDAQ and S&P 500, and so that's dragging things lower. And in terms of, you know, what we heard from Powell, there was nothing that really affirmed like a crazy dovish bias.
Yeah, he spoke at the Economic Club of Chicago.
He did.
Right, today on Wednesday.
Literally like 30 minutes ago.
Yeah, April 16th, Wednesday, around 2 p.m.
And he seems very measured and pretty consistent with the message he gave us last time he spoke publicly. And that message is, you know, we still have a two-sided mandate, right? And they have to make sure that, you know, inflation expectations and inflation doesn't get out of hand. And the balance to that is, you know, the unemployment picture. And so, you know, Waller basically set out a framework to think about it, you know, late last week. And he was basically like, if you have a really aggressive tariff scenario where effective tariff rates are 25% or something in that neighborhood, then, you know, the Fed can potentially overlook some of the inflation concerns because unemployment will definitely tick higher in a meaningful way and growth will slow down a lot. And so then you can have the more aggressive Fed path. But if we go with the more measured approach, which is like, you know, let's say 10% baseline reciprocal tariffs and nothing too crazy beyond that, and you get some trade deals done, then that's a scenario where the Fed can actually be like much more data driven and much less kind of concerned about like a left tail scenario. Yep. And so, those are kind of the two paths that we can follow. I'm more inclined to think that we are going to go down the route of much more aggressive tariffs, much more aggressive slowdown in the U.S. economy. Some of the stats about the U.S. consumer have not been good recently. Starting with I'm pretty sure 12% of all credit card balances are only 12% of payments on credit cards are minimum balance payments now. The stat about Coachella was really impressive to me. Apparently 60% of folks are on payment plans.
I know, for the tickets.
For the tickets.
Buy now, pay later.
Correct.
For like escapism.
Correct. And, people are doing that with like Grubhub and, these meal apps. Savings rate has really come down. You've seen some delinquencies, tick up in autos and in kind of lower credit type of stuff. And so, I really do think that you're at the point where the consumer is stretched, like living paycheck to paycheck type of stuff. And so when prices go up, that's effectively a tax on a ton of people. And that should only help kind of fuel this kind of downward spiral and growth and employment. And you have a Fed that like is kind of constrained by the inflation side of things a little bit. And
where are we on inflation these days? It's not a headline story. Not because it's not going bad, but because
here's the
there's
thing,
other
you just
headlines.
don't know yet because the tariffs haven't been fully taken effect yet, and it hasn't really hit the hard data. And so it's really hard. This morning you had retail sales that were pretty strong for the month of March. But again, could that be because of folks front-loading consumption in fear of tariffs?
Picking up new iPhones and other technology,
other
imported things, whatever, right?
So it's really hard. Some of the more high-frequency data points we look at, like restaurant reservations and, kind of some shopping figures, et cetera, like they're down in April.
Really?
Like they're not good. Like restaurant bookings, I think, are off like 5%. Which is like a pretty big deal.
Yeah.
And a lot of the turmoil in markets happened in the last 2 weeks, right? And so, like, when people were checking their statements and stuff, like...
It didn't make him say, we want to go out for a fancy dinner?
It did not, but it just like, started, right?
Yeah.
What does 5% to 10% less in restaurants do to the rest of the... the suppliers of the food, the waiters, how do they spend their money?
Yeah.
Right? And so these things take time. To really hit the hard data. And so, which makes it really difficult for the Fed because they can't really act without that hard data turning just because sentiment is bad. Like, people can feel bad and still be spending a shit ton of money, right? And so the hard data might not turn yet. Right. And so, I think the Fed's going to be a little bit behind the curve at a certain point. But in my head, consumers super weak. You'll see that show up in the data. We know that there are layoffs that are going to hit the employment data, particularly government layoffs. We've had corporate America tell you that it's really uncertain right now. They don't want to make plans because things are super uncertain. That includes hiring plans, CapEx, you name it, restructuring, all that, like bringing manufacturing to the U.S., all that stuff. Like nobody wants to do anything. Walmart pulled their guidance.
I saw that.
Right, and so I think you're going to have more and more folks that corporations mainly that are going to be like times are uncertain ahead, and we might as well kind of bring our kind of forecasted earnings a little bit lower, and so I think you're going to see meaningful retracement in like earnings expectations as you go through the year.
Yeah. That's a lot.
That's a lot.
Wow.
And at the same time, we haven't even touched on the big thing, which is like the dollar.
Right.
Right. And the euro is at, almost 114.
Wow.
Right?
Is it really?
It's like 113.
This is over just the last couple of weeks. The dollar
last couple of weeks, massive sell-off.
So DXY was sub 100 briefly.
And so, what's happening is, there's a huge international shift away from the U.S., whether that's U.S. equities, that's tourism to the U.S. or dollars.
And treasuries.
Right? And treasuries. And so, there's a massive flight away from the dollar. And so that's really interesting because like take something like dollar yen, right, where interest rate differentials would suggest that, you know, dollars should be richer versus yen, but they're not. Yen's been rallying, and that shows you that there's structural dollar selling flow in the market. And, you know, that's also led to things like gold repricing significantly higher. Every day, it's a new all-time high in gold. We're talking about an asset that's returned 26% year to date.
I know. It's crazy.
It's a phenomenal, you know, debasement hedge, dollar, kind of weaker hedge, you know, and
central bank asset, sovereign asset.
Right? And so there's a ton of money plowing in. Today was like a record day in GLD, like call option buying. And so folks are piling in. And
that portends difficulty for the dollar. And
it really strikes like a very concerning note. And, you know, the main person that's been speaking on this and kind of a shift in kind of the monetary structure we've had for a really long time, Ray Dalio, right? And, you know, there's a lot of things we can get into, but trust and faith in the U.S. and the government and the monetary order that's existed since Bretton Woods, right? Like you're, you know, potentially challenging that.
Well, that we were talking about this before. You absolutely are. It's by on purpose, right? Because there's this famous concept, the Triffin dilemma, which Robert Triffin, an economist in the 60s, observed. And the dilemma postulates that the issuer of the world's global reserve currency necessarily will result in them having a trade imbalance, because to be the global reserve, you have to export your global currency to the world. So in our case, we're exporting dollars. We are a net exporter of dollars. That's why we're a net importer of goods. People are buying dollars from us with goods. And when you increase the cost of buying those dollars with your goods, you directly imperil the growth and position of the global reserve currency. That's what's happening, right?
No,
we're telling people, hey, we really want to sell you these dollars in exchange for your textiles or your minerals or your electronics or your chips or whatever, but you're going to have to pay more for them. And people are like, well, I don't want to do that. You're supposed to have a trade imbalance in order to maintain the dollar reserve status, which is why it's one thing to tariff if it's unfair and barriers or whatever, but to do it to rectify trade imbalance is directly threatens the dollar status.
Yes, fair enough. I think there are more things going into threatening the dollar status besides, you know, kind of.
Well, I mean, the uncertainty of the rollout as well is like, because if you buy sovereign debt, it's inherently a bet on the stability of the sovereign.
Correct.
And we look a bit unstable.
Yes,
to say the least.
The level of volatility in the bond market over the past 2 weeks, and the fact that the Treasuries didn't really act as good protection in that period, right? One of the reasons you'd want to buy fixed income is, maybe it's a hedge again in case risk assets sell off. So, you know, when it doesn't start performing as well as you want in those scenarios, then it makes you think like, you know,
maybe I should look at gold.
Why am I long this
You're
thing?
right.
And then there's also the classical arguments of like, there's not enough term premium. Why would I go out 10 years or 30 years when I can park money in the very front end of the curve and, you know, get similar returns?
Almost the same, yeah.
Right? Like right now, 10-year Treasury is 4.30.
Yeah.
Overnight money is 4.33, right? And so there's a lot of cuts baked into the market.
Yeah, but why would you buy the 10-year?
Right? And, you know, relative to where the 2s, 10s, or 5s, 30s has been historically, like there's still room to run by like 100, 200 basis points in certain instances in terms of like where we can get to in terms of term premium you need. So like there's a lot of moving pieces, and this is one of the most challenging environments because the administration is hard to predict. You know, high level, you know, I do still believe in the kind of the ethos of what they are trying to do. Like if you hear Bessent talk about explicitly what he's trying to do, and he's like, okay, we're running a $2 trillion deficit. We need to bring that deficit to a reasonable portion, you know, relative to GDP. Bring it from 6% plus to 3.5%. How do you do that? $300 billion a year, maybe $400 billion a year. But ultimately, like, yeah, the debt path is unsustainable,
right?
And it does need to be addressed. And there's no way to address it like in a peaceful way, not like fighting, but like in a way that doesn't harm a lot of
disruptive.
folks. It has to be.
It has to be big cuts and big revenue increases, and you got to get them from somewhere, right? And you're cutting with Doge and other things, and they're trying to get the revenue from tariffs. They're trying to get it from tariffs rather than taxes.
And deregulation and
pro-growth
policies.
No, I agree. And the fact the second term non-consecutive president actually has the political, he has a political mandate on this, frankly, from a lot. This is why Besson was highlighting, right, the small portion of Americans that actually even own stocks. Yeah, it's like, you're asking me on CNBC about this terrible rout in stocks. A lot of our voters, basically, he doesn't say it this way, but basically a lot of our voters don't even own stocks. Yeah. So, like, this is kind of what the plan is and was.
In theory, like, there's a lot of people that would want cheaper goods. How do you get cheaper goods? Recession. Like, it's super hard, but, like, nobody can come out and say, oh, I want a recession.
Right. And
like,
they don't.
Impossible.
Besson said there won't be. Right? They're still saying they don't want one and there won't be one.
Yes. Which is like telling me, like,
what are the odds now from like Goldman and others? I've seen like, what are the odds, the recession odds now from the banks? I've seen
60%.
Yeah. So
like, but again, it's like what like 2 quarters of negative GDP growth. Like,
what do you think?
What does that fucking mean?
I know you've been very down on digital money, digital gold money, magic internet money in this environment. But you know, with gold ripping like this, with multipolarism becoming a more prominent feature in the geopolitical landscape, right? Like you said, reduce exposure, even reducing travel to the United States. Doesn't it stand to reason that this is an environment where at some point you might see entities, sovereign wealth funds, nations turn to digital gold as an alternative here? Shouldn't
possible.
It? Like, isn't that what Bitcoin is built for, though?
It is. But my thing is, you need to respect what the market is telling you. The market is telling you that in the gold outperforming scenario, like, gold is the trade. That's why gold is up 26% year to date, basically in a straight line.
Bitcoin's down 9-10%.
Yes. And in hyper volatility, like, it's really tough to justify losing money on Bitcoin to your board of investors, or anybody that has.
So it just hasn't turned the corner yet as the hedging asset.
Yes.
It's simply
if it starts performing, though, I could see a lot of people chasing it, a lot of macro types.
Yeah.
But at the same time, it's like, wait, I could get similar returns to, like, if Bitcoin's bouncing, there's a good chance that stocks are bouncing, right?
I agree.
Like, there are just so many alternatives.
I'm more thinking about the fundamental trade here. If you're like offshore, it's one thing if you're an investor trying to protect in this environment and you're saying, look, I'm not trying to take the additional cryptocurrency market risk of Bitcoin or whatever you think there is. But if you're a non-aligned nation, you need to move assets in this new world. You can't trust dollars, or you don't want to.
And gold's tough to
gold,
move
you can't
and
move and do. You can't send shares of GLD around.
So think about this.
Like, shouldn't it like work like in that way? Although there's obviously more volatility.
Yeah, more volatility. But think about this. If you're sitting in Europe, like, you're looking at Bitcoin, right? And it's pretty close to the lows. You know why? Because you're thinking about it in euro terms. And so euros, let's say, up 10% from, like, a month and a half ago. Yeah. And so in theory, the Bitcoin price to them is 10% relatively lower. Right. Right. And so the people abroad that are looking at Bitcoin on a non-dollar basis, like, it doesn't even look this good, is what you're saying. It does not look that good.
It looks even worse than it does to us here.
Yes.
Interesting.
Yes. And so, like, I don't know.
It hasn't sort of found its. Yeah, that's fair. That's a fair point. Right? It's an interesting point.
Take a look at the Bitcoin Euro chart.
I will.
Right? It's still very close to the
It'll probably be the first time I've ever looked at that chart, but you're right. I will.
Right? And so, like, there's a lot of things that could take Bitcoin higher. I do think that a bounce in equity markets is the most likely thing to take equities higher, because it starts the flywheel of,
we want to do investing again.
Yes. Yeah. And it's also like MicroStrategy, right? They're a large buyer. They've bought like $8 billion of Bitcoin this year, and their stock chart's trading well, and they do more corporate actions and are able to buy more Bitcoin. Ton of other similar companies out there in the marketplace, and so I do think that
could happen.
That could happen.
Yeah.
And you just got to keep in mind.
Real quick, didn't it feel like the tariff sort of like tantrum? They were calling it a tariff tantrum. It was sort of like the market lingo. Got the 90-day pause. Now it's sort of like you got some deals that look like they may start to emerge with some important, generally friendly economies, but big ones. Japan, Australia, I've seen to Korea. you know, and they seem to be really focusing in on China. And yeah, you talked about this, I think, last week. You do have the two largest economies going tit for tat against each other. It's not great for the global economy and global markets, but like, are we maybe through some of the most shocking like headlines around this, and now it's sort of a U.S.-China trade war with a little bit of peripheral damage? Doesn't it sort of?
We're not through the worst of it.
You don't think so?
The data hasn't actually turned yet.
Not the economic data, but I just mean the tariff headline.
The headlines, yeah, but like people will react very poorly to.
And they see the trickle down stuff that ends up happening.
When people when you get a non-farm payrolls that's negative for the first time in like a really long time, right? When retail sales is like, oh, it's down a ton, right? Like, trust me, people will panic one more time.
All right, I don't mean the lows for the market, but I sort of mean the you know, are we through the worst? Do you think? I know it's impossible to answer given Trump, but of the tariff like headlines.
Yes, you know, but. I would think so. I think everything's going to be a little bit more gradual, and also folks just get desensitized.
Yeah.
Right? It's like, okay, how high can tariffs go between China and the U.S. now? Like, China was like, it doesn't make any sense for them to go higher. Like, it's already, like, prohibitive.
Yeah.
Right? So, like, you know, you raise them another 50%.
We're in a détente.
It does nothing.
Yeah.
Yeah. So, you know, it's a challenging market, but I would agree with you that you're probably through the worst of the tariff headline ping pong.
Yeah.
I just don't think you're through the worst of the market. I think you're headed for a slowdown.
All right, Beimnet Abebe, our friend from Galaxy Trading.
Thank you for having me.
Let's go now to our guest, Max Bareiss, head of lending at Galaxy. Max, welcome to Galaxy Brains.
Happy to be here.
It's been a long time coming, and it was a good time because we just published this big lending report, and I figured let's talk right to the guy who runs lending at Galaxy, one of the biggest loan books in crypto. Is lending back? It's growing.
Yeah, I mean, 2024, it was a starvation of leverage. I think that there was so much opportunity in the space. You saw everybody looking to max out their credit books to try and take advantage. I think basis across 24 was oftentimes over 20%.
So people wanting to be long, but having very low access to leverage.
Not even long. You don't have to be long. Like, some people are definitely levering long because that's a signal that Bitcoin's going to rip. But it was really more, you could capture that spread just by buying Bitcoin and selling Bitcoin in the future.
Totally, the basis trade. But I mean, in general, like, why a lack of available cash? Like, what was causing it to blow out to such high levels?
Yeah, I mean, you need access to cash to be able to capture that. So the exact trade is literally take cash, buy Bitcoin, sell Bitcoin in the future. It basically establishes what the like Bitcoin-backed lending curve is. So it's the 1 month, the 2 month, the 3 month curve is literally set by the basis trade.
Yeah. So, but people they couldn't collapse that down because there wasn't enough cash doing that trade?
Correct. There wasn't enough cash.
And part of that's because there wasn't enough lending to provide, not enough credit to help facilitate the trade.
Yeah.
Because we're still from the hangover from 22.
Yeah. And you saw that in DeFi. So like the DeFi rates were spiking to like the same levels as the basis trade. And a lot of that happened, I would say 24 in March and 24 in November, the two like major run-ups in Bitcoin. You were seeing the DeFi rates also going over 20%. You were seeing the basis trade also over 20%. And then you didn't have that like inelasticity that you had probably back in 21 where you had a lot of centralized lenders and capital was like moving around much more freely. And so because of that, that's kind of where we saw like the crypto lending market picking back up from the centralized standpoint.
Interesting, yeah, because it is back a little bit. Centralized lending market. DeFi is up quite a lot from where it was years ago. I think that's just general adoption.
And trust. If you think about it, like the first creditor paid back in Celsius was DeFi. They had to. The computer wouldn't let you unless you repaid your collateral.
Yeah, they couldn't
get your cash back.
Couldn't get the cash out. That's
Yeah.
interesting. Yeah, and no major crypto lending on-chain DeFi protocols applications like collapsed really during that.
There was not during, but I mean there's on-chain risks.
Well, there are. That's right. I don't want to present like they're not, but I feel like the transparent auto-liquidating functions of these had during that deleveraging performed quite well, whereas the Celsiuses and the Genesises and the Voyagers collapsed.
Yep.
So
yeah, I mean that's exactly right.
Yeah, so I don't know, maybe for for me, like what are the risks, the various pros and cons, maybe of a centralized lending book versus a DeFi application? Like, I don't know, or help me understand like the differences. Like, why are they both growing right now? They're both growing.
I think it's also like know-how, right? I don't think people know how to utilize on-chain. I think on-chain risks are totally prevalent, and I think that there's things like you mentioned, auto liquidations that scare people away. You don't get that white glove service where, I mean, if somebody's in margin call, I'm waking them up. I'm calling them at like 10 o'clock. They're in somewhere in Europe, and I'm waking them up and being like, there was a massive move down. Please top up. I don't want to have to put you into like any kind of liquidation or even have to make that determination. Check your phone, please. And we've been having a lot of success with that, but it's definitely a 24/7 job.
Yeah, it is, right, in a global market. And you can like, can you do different structures and stuff that are not available, like widely available? Maybe they're possible, but they're not widely available on chain.
Yeah, 100%. I mean, that's sort of our bread and butter is we customize everything to whatever the client needs. Things like collar loans, which is the Jason Urban special, you can get 0% APR. You sell a call, you buy a put, you use the call premium to basically pay the put premium. You issue a loan on top of that. You can basically combine all three of those financial products. You use the call proceeds to pay the interest on the loan and the put all at the same time, and you basically create something that you can't do on chain.
That's really interesting. How many people are trying to do this stuff on chain, though? I always see these like financial engineering types like reinventing, I should say, new structures on chain.
There's a lot of lending protocols on chain. I know that just generally on chain is growing in adoption, but you need that time element to make sure that like the protocol is tried and tested before people are willing to dip their toes into it.
Yeah, protocol risk in general, right? It could just be a failure, let alone a hack.
I mean, you could have like Oracle attacks or like things that you don't even think about where the computer's manipulated.
Right.
And so that is the on-chain risk.
Yeah, there is still plenty of that. That's super interesting to see these things. I wanted to ask you, like, where is the new demand coming from these days? There was a lot of retail lending demand in 21 and 2 that fueled those companies. There was other demand as well, but we don't see. There's a few retail lenders that are pretty big now, but like doesn't feel the same. Like, has the character, nature, maturity of the borrowers?
I
and
actually think it's
increased?
coming back. I think that you're getting a decent amount of retail lending. Getting interested in, or I guess borrowing, getting back interested in the space. A lot of people have Bitcoin that they've seen accumulate in value. They have no interest in selling, but they need the cash to start financing their life. And so you're seeing a bunch of these new retail lenders coming out of the woodwork and coming up with creative structures to, I think, avoid rehypothecation. I think that, I mean, publicly we did that deal with Arch Lending where they don't allow for rehypothecation. We had to figure out a way to give them leverage. And so we did that CLO kind of construct where you create that SPV below, you have the equity first loss that Arch is putting up, you sell the loans down, and then Galaxy's providing that warehouse line against it. And then we're going to look in the future to securitizing the debt and figuring out a way to create like a debt capital market offering that will basically expand the retail offering within the space.
Another one that we see a lot of miners, and by the way, not just miners, corporates in the market buying Bitcoin, for example. Are there miners or other Bitcoin corporates, Bitcoin treasury companies that are in the lending market in some way?
I mean, definitely. I think one of our unique areas here that we have is the access to our mining team. And so I've partnered with them to underwrite a decent amount of these miners. We're providing loans against the land, the infrastructure, the power assets, and then running a discounted cash flow over 5 years, like basically creating a terminal value, a value for the mining assets, and then working through the LTV, the protective covenants, and then creating that offering that we're uniquely placed to do. Because in the event of a restructuring or a downside scenario, we know how to own and operate this stuff.
Yeah. Is it like the ASIC-backed lending from the prior thing, or do people still do that?
So I would call that miner finance 1.0.
Yeah.
I think that ASICs have a pretty liquid market, so people thought that it was really easy to underwrite the ASICs. You knew where the market was, and that you would be easily able to kind of sell out of that. And I think what happened was there was a lot of the hosting model where people were underwriting the ASICs, and then they had to take repossession of the ASICs. It was a lot less liquid than Bitcoin, and Bitcoin went down 80% in a very short amount of time. And people ended up having to just put these ASICs in warehouse and then have to try and figure out a new way to kind of deploy it. The ASIC value actually probably decreased at a quicker rate than Bitcoin because it was depreciating at the same time. And so that's why we're taking Miner Finance 2.0, which is power assets. It's really, you want a turnkey solution where if you have to collapse on the assets, you're basically hashing right away.
You're just taking over the data center?
Yes, exactly.
Interesting. Yeah, because the ASICs, there were, I feel like, a fair number of lenders who became miners because they had to seize a pile of ASICs.
Yeah.
And they were like, well, I guess we got to turn these things on now, if it's profitable to do so. There was a lot of that in 21.
Yeah. I mean, too much, I would say.
Yeah.
To the point where we are looking at it in a very different way. And I think that people are getting interested in power assets again with the AI HPC narrative. But Bitcoin mining in particular, I don't think they have the same amount of access to lenders as they did back in 21. A lot of it's just because of like Bitcoin mining economics are a little bit more challenging. They're harder to underwrite. You have not that many lenders that actually understand the assets. And so that's kind of where we found a little bit of a niche in terms of like our ability to come in there and actually help finance some of these guys.
Do they are they, I feel like an enormous number of them declined to hedge properly their Bitcoin exposure in 21, right? They had held tons of Bitcoin on their balance sheet. They were bullish Bitcoin. They were mining below the cost of Bitcoin. So it was a Bitcoin acquisition strategy. And then they didn't hedge or plan well enough for the downturn, and a lot of them ended up like puking their Bitcoin stack, or a lot of it, right? Are they more sophisticated now too? Is it not just Miner Finance 2.0, but mining Bitcoin 2.0?
It depends on the miner. I think that a lot of them and a lot of their investor base, it really depends on what's actually driving people to buying their stock if they're public. And I think a lot of them just kind of want that beta play to Bitcoin. And so I see a lot of miners holding a lot of Bitcoin on their balance sheet. And I think some of it's strategically, and that plays really well for some. I think some of the other ones are selling a little bit more as they go. They're pure play miners. They're really thinking about like the actual operational nature of Bitcoin mining. And so it really just depends when you're starting to talk to these people, how they want to position their balance sheet.
There's a lot of disparity then across the market of different strategies at this point?
I would say yes.
So it's sophisticated. It's more, it didn't feel like it was nearly that sophisticated.
Well, I think that there's also a lot of miners that are pivoting completely to AI HPC. And so, I mean, you have miners that have multiple strategies just given like, what is their power asset? How do you use the power asset? What's the highest and best use case for it? And so we're seeing sort of that diversification across the board.
Pivot a little bit. What's the relationship, the borrow and lend rates for something like Bitcoin that you see? What is the relationship with like traditional, like the Fed funds rate or treasury yields? Like how do these things move together? Or are they totally different?
I actually think that they diverge quite a bit. And I saw that really, I would say, the last summer. So like I would say August timeframe when we started cutting rates. What happened was a bunch of my counterparties came to me and said, hey, can I get a rate cut? And really what happened was the basis trade started to explode because it was risk on. People were taking leverage to buy Bitcoin. And I pointed this out to them and said, actually, like I'm probably in a position to raise your interest rate, just given the fact that I could point to the basis trade and you can kind of see across this curve where everything's at. And they kind of looked at me and were like, you know, you're kind of right. Can we increase our loan at the same rate? And yeah, I mean, we ended up taking on even more loans because of that. It was like client acquisition, but took a little bit of education to actually get them in a position where they understood why it was not coming down. And, you know, it was just sort of like, so inelastic.
Kind of like uncorrelated, at least at times, with like sort of the traditional rates environment. Like that's a Bitcoin specific
Well, it's
reason.
a risk thing, right?
Yeah.
Because Bitcoin's a commodity. It's very easy to like look at the curve associated with it. So like you could synthetically create a borrow by taking Bitcoin, selling it, and then just buying the future.
Yeah.
And so that just creates cash, right? And that's literally just a synthetic loan.
Yeah, it's very... I mean, how liquid is Bitcoin when you think about it as an asset? That, I mean, you guys touch a lot of cash also.
I mean, it's very, very liquid.
Yeah, you can get in and out of massive. I mean, just from someone who's a day-to-day practitioner, you know, I mean, I know that it's liquid. I mean, but I'm not actually testing that. Remember when Elon said he was testing liquidity by selling some Bitcoin?
It's very liquid. It's very, very liquid.
So you can move in and out of billions of dollars?
Yeah, and we've worked through that.
What about Bitcoin yield? Like, you know, there's, for example, Babylon, or this was a restaking protocol that, you know, you could deposit your Bitcoin into. I've never really understood these, and I'm certainly not endorsing it, but there are people that, you know, have a Bitcoin stack and are looking for ways to generate yield in Bitcoin terms.
Yep.
Can they do that? Is that possible?
I mean, there's a lot of different ways. So, like Bitcoin restaking, I think you have to look at each of the protocols and understand where the yield's coming from. There's obviously just lending Bitcoin. I think lending Bitcoin has seen an uptick in the market, but inherently it doesn't make sense unless the borrower is taking it in unsecured, because you're not in a lot of it depends on the rate environment, but you're oftentimes not looking to borrow Bitcoin and post something like cash, because cash is the more valuable asset for the most part, depending on the strategy.
What do you mean about that?
I think for the most part, people are looking to pledge their Bitcoin and borrow cash. So I mean, that obviously has a rate attached to it. Like I was saying, it's the basis.
Yeah, so there's not a big demand side on the Bitcoin yield side, right? To pay the yield to the lender. Not a lot of people are posting cash to borrow Bitcoin.
Not a lot of people are posting cash to borrow Bitcoin. The reasons people borrow Bitcoin is because there's a lot you can do with Bitcoin as a general collateral asset. So for something like exchange leverage, right? You need Bitcoin on exchange to be able to finance a trading business. You can generate cash doing the exact thing I just mentioned, selling Bitcoin and buying the futures contract.
But you can't generate Bitcoin.
You could post the Bitcoin, right? And then you could borrow cash. You now have cash where you can then do some of the things that will generate yield, whether that's doing the basis trade or deploying it on chain and figuring out whatever the highest and best use case is and transforming it from cash to Bitcoin to ETH to Solana. Figuring out how to do that in delta neutral ways is sort of like what we do between like my book, treasury, the credit book, figuring out how to actually continue to like move the assets around and whatever will make us the most money.
So, but like that, doing that trade, borrowing cash off your Bitcoin, then taking the cash, using it to do some yield strategy, whatever it is, like the basis trade, you aren't generating Bitcoin native yield. You're generating cash yield, but then you could take the proceeds and buy back Bitcoin. Is the idea?
Yeah, I mean,
theoretically, if you wanted,
that's kind of like what Athena's doing, right?
Yeah.
So like you're basically depositing your ETH into Athena. They're staking the ETH, and then they're running the basis. And I know that there's more to it, but I'm going to just simplify it for the purpose of this conversation. And they pass back yield that way.
But they pass
Babylon
back
is
dollar
kind of
yield,
similar.
right?
Yes, but Babylon's similar. Like I don't want to get too in depth on it, but like you're staking your Bitcoin. You're not generating Bitcoin. Bitcoin's not a staking protocol. You get your yields in other ways.
And then, but if somebody comes in and says, I want to give you Bitcoin and I want you to pay me yield in Bitcoin, that's the idea, is that some trade like that, you're generating yield and then purchasing the Bitcoin to give it back to them.
It's a carry trade. It's the lowest cost asset to borrow. And so you're able to then hold it on your balance sheet. And then when somebody comes in looking for any other trade, I have the liquidity needed to make sure I can give a show.
Bitcoin as that collateral.
Correct. I can always give a show, no matter what. I can turn Bitcoin into any alt, and I can figure out a delta neutral way of doing that, and I can quote a rate. It's just math.
Yeah, it's super interesting because, Ethereum and staking protocols effectively have a risk-free rate. If I come in with $1 billion and say, I want to earn ETH native yield on this ETH, $1 billion of ETH, I mean, worst case, you could just stake it. And by the way, the person bringing it could also just stake it, right? Like there is that. Bitcoin is like a gold-like commodity. It's not a financially engineered proof-of-stake network. But I hear about this question, generating yield on your Bitcoin, right? And I think it is important to ask, you said this before when it came to like the different protocols that do restaking, like where does the yield come from is the question, right? And that's where risk emerges, right? That's why it's called risk management.
Yeah.
Right? It is interesting though. Like, do you see an uptick in people wanting like to not just like to earn yield on their Bitcoin? They don't want to sell. You talked about people borrowing cash off their Bitcoin to finance their life, to buy a house or whatever, whatever it is. Are people coming in saying, I want to earn more on top? Or when do you typically see that question? Is that something people say during bull market, like big bull market spikes? Is it something they say in bear markets?
I think it's always. I think people are always looking for creative ways to do it, but it's risk management. It's when you lend your Bitcoin to somebody, counterparty risk is the main thing you have to take into account. And so you need to know who you're lending it to. If you're lending it to Galaxy, you're taking a look at our public financials. You're having conversations with not only me, but our risk team. You're asking, what are we doing with the Bitcoin? It's super important.
Yeah.
And we try and be as transparent as possible and give them actually everything that they're asking for. But that is what they have to take into account when you lend Bitcoin. You're getting yield that way.
Yeah, it's super interesting because that's at the core of that, 21, 22 blow up of the lenders, not Galaxy, but others. And we've seen, a lot of those ended up in court, and you saw a lot of lenders making not telling the truth about what they were doing with the Bitcoin.
Or asset liability mismatch.
Well, that's right.
I think that was like a decent amount of it. They were borrowing it open term, and then they were lending it on term.
Or they were
and
taking
then there was a run on the
endogenously
bank.
created assets as collateral.
Yeah. I mean, there was a lot that was, because it was such a new thing, Bitcoin yield back then, I think people were just happy to get returns on it, and they weren't really asking some of the questions. It was a lot of retail. And so I think this time around, at least the counterparties we deal with are really taking that serious. They really care about our asset liability planning. They really care about what we're doing with the Bitcoin to generate the yield, to actually make sure that we're facilitating and paying them what we're saying. So if I'm saying, I'm able to give you 3-4% on your Bitcoin, the first question should be how.
Yeah.
And I have to be able to defend, this is what I am doing with it. This is how I'm able to pay you that 3-4%. And then that kind of, spawns a conversation of, okay, that makes sense. I understand your balance sheet. Let me talk to your risk team. We get through that conversation, then we kind of go from there.
Got it. Let's transition again here. I want to talk about TradFi getting involved, because you had SAB 121 said banks can't. Well, if banks hold crypto, they've got to hold it on their balance sheet. That's cost prohibitive due to bank capital requirement rules. You also had separate guidance prohibiting banks from touching crypto, really, from the OCC and the FDIC. Those are coming away. But so that's one area where, and we've seen some traditional financial institutions like Cantor Fitzgerald say they're going to start straight up Bitcoin lending business. I think mostly actually cash lending business with Bitcoin as collateral, most likely. And they're a primary dealer at the Fed for treasuries. It's an important financial institution. But you also have like prime brokerage desks, right? You've got the ETFs, which are securities.
And they've been around for now over a year.
You can do margin on securities. I think
100%.
Most brokerage firms will let an average person sign a margin trading agreement and borrow off of their securities. How does that? How do you? Yeah. Okay. Well, how big is that getting? The banks aren't really here yet. Not really, right?
I think it's coming.
Yeah.
And I think it's going to come probably over the next year. I think that there's a lot you need to consider when entering the Bitcoin-backed lending space. And I think the main thing there is you really need a 24/7 operational team, because these margin calls oftentimes happen nights, weekends, holidays.
They really do, don't they?
It's
Bitcoin is.
Ask my wife. It's always on the weekends.
Yeah, I'll have to get our team to produce a report on the volatility profile of different days.
Well, it's the lowest liquidity, so that's when you start to see the gaps.
And if there's geopolitical or macro events, it's one of the only things you can trade.
Yeah, 100%. So it sort of leads,
Yeah.
and then you have that lag on the Monday or whatever.
So they need that 24/7 focus, but
100%.
they also they're not used to that, are they?
No.
They don't really. They don't touch things that don't trade 9 to 5 or bank holidays. Not really.
No, and a lot of it then is they're going to come in and they're going to have very low LTVs. And a lot of it is they have to do the same analysis we do. It's what is the largest move over Bitcoin, during your period of risk assessment, which is probably going to be back to COVID, which was the large move. And so they're going to start to see that, you need to have an LTV over that 24-hour period close to a 60 LTV. They're going to realize that they don't have operational support Saturdays and Sundays, And then we're talking Easter weekend. That's Good Friday. Banks closed.
Yep.
So now you have to do it over Friday, Saturday, Sunday. If, for example, there's another holiday because of like the 4th of July, that's another day. And so you have to do it over 4 days. Now you look at Bitcoin's largest move over 4 days. That changes the calculus. Their LTV is going to be incredibly low.
Yeah.
And until they're able to figure out how to have that 24/7 operational support, I think it's going to be harder for them to get involved because they're just not set up for it.
What about with the ETFs? First, maybe as securities lending. I mean, are we seeing that that's ostensibly easier for the prime brokerage because it's not actual Bitcoin, right? They're just taking securities, similar volatility profiles because they track pretty well to Bitcoin price, but they also don't trade on the weekend.
Yeah.
So is that going to be
But
big,
I mean, doesn't
you
it
think?
just gap on Monday?
I think it does, yeah.
Yeah, so like it's the
They
same
still have
thing.
similar risks. So yeah, they don't have to touch the asset, don't have to control the custody of the asset, the act of Bitcoin. Are those going to be big? I mean, we had 35 billion in net inflows into ETFs as of like last week. Like that's 35 billion of new money into those vehicles.
Yeah. I mean, probably not a popular thing to say, but I kind of view them as the same. Like from my standpoint, like looking at the ETFs versus Bitcoin, like swapping between them, if somebody's more keen to have us pledge the Bitcoin ETF, sure, like we can do that.
It's pretty easy.
It's easy to swap it. Like there's slippage to do it, and it's just like a cost that you have to like calculate when you do some of these trades. But yeah, I mean, we can easily swap it. Sometimes they prefer that because they just have the tooling set up already to monitor securities. They haven't built out like a crypto specific margin call engine or whatever it is, and so they just prefer it in the ETF.
Right.
And well, sure, like we can do that.
Yeah, it's interesting. I guess that makes sense. I mean, it's the price. You're not. I guess you just have to have access to those brokers where you can't send an ETF share over a network. I mean, you must like that. It's nice to top up with crypto. I mean, if
you can top up to any wallet,
crypto
anywhere,
is
any
like,
time of the day.
It's pretty nice.
Yeah,
and what
you
about
just need to do your
stablecoins too?
KYC, AML, make sure you have whitelisted, but you're good to go.
Yeah,
like as soon as
for
you
sure.
have that.
If we have like stablecoin explosion and you never have to touch a bank wire again, would that make you happy?
Yeah. Yes, 100%. That's also a decent amount of our flow is like on the weekends. It's like, I need to do this. I can't get access to my capital. I need it on a Saturday.
We need stables.
Yeah, exactly. Stables are the only way to do it. Crypto
Yeah.
is the only way to do it.
Yeah, I mean, it's such a no-brainer.
Yeah.
I want to ask also about the ETF staking in the ETFs. I know the SEC is looking at considering approving the staking in the Ethereum ETFs. I think probably in Canada, do they already stake the ETH ETFs in Canada? I think they might.
I don't know about Canada. I know in Europe for sure.
Yeah.
And we've been working very closely with our blockchain infrastructure team
Right.
on this exact like thesis.
Right, because one of the questions the SEC I know is looking at is, well, how if we're going to allow, let's just stick with the Ethereum ETFs for now. Obviously, I think Solana ETFs just launched in Canada, which is interesting. Presumably, if there's demand and approvals for proof of stake asset-based ETPs, they're all going to eventually try to stake some amount. I mean, that makes sense.
You have to. Otherwise,
your
the
shareholders
ETF
effectively get diluted.
Yeah, why would you buy the ETH ETF when you can just have native ETH and stake it?
Yeah.
You're losing out to the inflation.
So one of the big questions, rightly so, is this like I don't know what's the right term.
It's asset liability mismatch is probably where you're going.
Yes, if there's a big outflow
a lot
day,
of redemptions, how do you make sure? Because the ETH staking queue could be infinite.
So ETH is perfectly interesting for this question, specifically because of the staking queue.
Right.
They
Because
have
you're talking
gates
Solana, you have 2.5 days. You know that. You can sort of plan for that.
Right.
The ETH staking queue, if you have mass redemptions.
How big has it been in the past? It's been weeks and months, right?
45 days is kind of what comes to mind.
Yeah.
But I know that like
We can check that, but much long. I mean,
it
too
can be,
long.
It can be quite long. Yeah.
So if you have too much of the
I think 45 days was like right after the Celsius.
yeah,
Like they started doing all of their withdrawals all at once.
so they gate the withdrawals, or the redemptions, or what do we call them? The unstaking
It's
activity.
math. I think it's based on epoch. It's like the amount of withdrawals, and then it goes from like 4 validators to 5 validators to 6 validators.
But if you
per
had
epoch.
too high a percentage of your ETF underlying assets staked and not ready to come out, not easily accessible because they're
So let's talk
and
about
you have
the
a large
product.
number. Yeah, well, that's what I'm saying. And you have a large number of redemption requests for your ETF. Now you're sort of stuck. It is that mismatch. Obviously, they're going to cap, I think, the amount that they allow ETFs to stake percentage of their thing.
Yeah.
I would assume. I don't know, actually. Maybe it's not obvious. Maybe they won't do it. I'm not
Yeah.
sure. It could be different for every product. But let's say, regardless, how can you mitigate that? Is there a lending product there?
There is a lending product there. And so I'm going to get pretty nuanced here, but the way we have been designing the product is an uncommitted credit facility for these ETF providers. And basically what they do is they take their ETH, they pre-pledge it to us as collateral, and they stake it to our validator. There's reasons for that because of control that we need it staked to our validator that helps us perfect our UCC filing, perfect our lien, etc. If they have mass redemptions, we have that as collateral, so we have Ethereum as collateral, and then we lend them ETH so that they can meet their redemptions.
So we basically have staked ETH, not like Lido staked ETH, but like ETH in the validator.
Yes.
And it can't come out right away because it's subject to the queue, but we
Yes.
just have other ETH we can lend them to perform the redemptions.
Yeah, I
in
mean,
the end.
there's a lot of ways that we do it.
There really are, right? I mean,
the reason it's uncommitted is because it would be capital inefficient for us to just literally hold the ETH on our balance sheet and we would lose out to the negative arbitrage that is us being able to stake it.
Yeah.
And so what that allows us to do is when it comes in, we don't have to have the ETH on our balance sheet. We buy ETH, we sell the perpetual, and then you're flat from a delta trading standpoint, and then we just pass that on to the ETF providers. And the best case scenario is they never utilize this product, but they have it available to them so that they
super
can feel
interesting.
good about
Yeah.
having the liquidity they need to meet redemptions when they actually come.
what gets you excited? Wake up every day, Max. Is it figuring out these math problems and connecting the dots?
I mean, there's a lot of things. I think that the best part about being in this industry is that it's a new thing every day. Like things that we just mentioned didn't exist a couple years ago. But it's trying to grow the book. It's figuring out how to do it and create the best lending book in crypto. That's kind of our goal here. And then also figuring out how to make the most money. Sometimes it's doing a loan in a way to make sure that it leads to other things, because Galaxy does everything within trading, and just utilizing that to like create that franchise benefit because we have so many different things that we're able to do, and making sure that we can lead with a product offering that's, you know, user friendly but very safe, takes risk management very seriously, but offers the things that our counterparties need to trade in the ways that they want to.
Well, I really appreciate it. It's been very enlightening, Max. Max Bareiss, head of lending at Galaxy. Thanks for joining us on Galaxy Brains.
Thanks, Alex. Happy to be here.
That's it for this week's episode of Galaxy Brains. Thank you to our guest, Max Bareiss, head of lending at Galaxy, and our friend Beimnet Abebe from Galaxy Trading, as always. What a weekend last weekend was in Bedford. I cannot stress enough how fun that was. Great to see the teams win. And again, shout out to the Real Bedford Football Club of Bedford, England. Everyone have a safe and happy weekend. We will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.